Hello everyone, welcome to Thai Finance. Today we're going to talk about financial ratios for the stock market. I will start by defining what are financial ratios. I will explain with a few examples how they work, and as well, you will exactly know how to apply them to identify opportunities in the stock market. This will give you the tools so you can analyze and compare two different companies or more and choose the best one. If you think this is interesting, you should definitely watch this video. So, financial ratios for the stock market. This will be very useful for you to choose and compare many companies in the stock market and decide whether you want to invest in one company or another. So what are financial ratios? It's a way of comparing two or more sets of quantities. Ratios show how one item compares in proportion to another. And let's explain this with a drink. We will prepare an Irish coffee. So for Irish coffee, you need 2 parts of whiskey and 4 parts of coffee. This is just a random recipe of mine. For me to explain you, this has a ratio of 2 to 4 parts of coffee. 2 parts of whiskey, 4 parts of coffee. And let's continue with our example. Let's say we have a person A and a person B. Yes, they both will have an Irish coffee in the morning. So the first person gets 1 part of whiskey and the second person, person B, has 3 parts of whiskey. And then they will fill it with the coffee. The first person, person A, has an Irish coffee with a ratio of 1 to 5, which is 1 part of whiskey to 5 parts of coffee. And person B will get 3 to 3. 3 parts of whiskey, 3 parts of coffee. And I want to ask you a silly question. Which one will have a better morning? Of course, person B. I want you to get interested on the proportions, right? We're focusing on whiskey now. So we want more whiskey to have a better morning. Let's continue. So everything is about fractions and proportions when it comes to compare companies. So the numerator of any ratio is the top number of a fraction and indicates the number of parts chosen. And the denominator indicates the number of parts in which the unit has been divided, and it must be different from 0. As I told you with the whiskey, just check if the numerator or the denominator is positive for the business. In this case, we will focus on the business and not on the whiskey. So this will determine if a higher result or a lower result is more desirable. So here we have an example where the numerator is higher than the denominator. So the result is always going to be higher. And here we have the opposite example with a numerator smaller than the denominator. So the result will be lower. I will give you some examples of profitability and margin ratios. Here on the left hand, we have just a simple profit and loss statement, a random one. And we will start using the financial statement of this company into ratios. So let's start with the first ratio, the net margin. And for that, we need the net income and the sales. So we place the net income, which is 630, divided by the sales. And in this case, it will give us a 6% result. And you have to convert it, of course, into percentage, multiplying by 100. And then we have another ratio, which is the gross margin. And for that, we have to get the gross margin and divide it by the sales. Here we have the 2,000 divided by 10,000. So in this case, we have to focus, as I told you, as with the whiskey, what is more positive for the business. Here we have 2 different results. And of course, we don't know if we want a higher or a lower number. So I will explain it in the next slide. Parentheses for you to subscribe to the channel to get the latest financial tricks. So check if the numerator or the denominator is positive for the business. And this will determine if a higher result or a lower result is more desirable. So let's start with the first ratio. The current ratio is current assets divided by current liabilities. So in this case, of course, having more current assets than liability, it's in our interest because it's just better for the business. In the last example of a higher numerator divided by a lower denominator, it's just much better here because we want more assets than liabilities. And our second, debt to equity ratios. And here we have total liabilities divided by total assets. And here, because we want, of course, more assets than liabilities, because it's just much better for a business to have more assets, here we want a lower result, of course. So when using ratios in a company to measure its performance, you can use these ratios and measure from time to time how it is this ratio behaving. And there are many ratios out there. Use the ones that are key for a certain industry. And the best ones are really the ones that you can understand. So search in the internet or in books ratios and use them as you want, but understand them first. So here we have two financial statements from a random companies. And both have a vertical analysis, which I showed you how to make it in my other video. I will post that video on the upper right corner for you to click and watch it. So here we have a vertical analysis, and all the items in the income statement I divided by sales. So all of them are ratios or percentages or proportions of sales. So the first one, we can see that sales are just 100%. One company has more revenue than the other one, but that doesn't mean it's just better. Look at the net income. The second one has a lower proportion of net income than the one on the left side. And of course, it's more desirable to have a higher net income, right? A higher percentage. So in this case, the company on the left is just more desirable to have. But then if you look at the operating expenses, that's where the main problem is, because the first company, the one on the left, has lower operating expenses than the one on the right. So as well, it's just much better to have less operating expenses. Finally, we have the financial expenses. As you can see, the company on the right is high leverage, let's say. It's high, they are paying a lot of expenses, financial expenses, and maybe that's the reason they have more revenue. It is just much better to see the whole picture. Just with ratios, you will get to nowhere. You have to know many things about the company, about the industry, and use the ratios to just compare the proportion within the same industries. It's just much better use of ratios. So when you decide to invest something in the stock market, it is better to use the fundamental analysis, the strategic analysis, and as well the technical analysis. When comparing and in deciding is of course not easy. So identify the reporting company's industry and compare it with a direct competitor. Do not compare apples with pears. This means don't compare technological companies with banks. And identify the seasonality of sales. Sometimes it is better to compare one or more quarterly results. For example, toy industry, they just have sales on Christmas. Well, not just, but most of their sales will be at the end of the year. And something like Coca-Cola will have, let's say, more stable revenue throughout the year. So identify the reporting company strategy, predict the possible consequences of this strategy, and assess whether it is appropriate for this company. You have to know everything, as I told you. Even though who's running the company, what is the strategy, what is the company selling, how is the economy at the moment, is it the right time to sell that product that a certain company is offering? So you have to consider a lot of things. And just to remember you guys, please subscribe to the channel to get the latest financial tricks and financial entertainment. You will learn a lot. Just click the button below, hit the subscribe button, and of course get the notifications with the bell. So thank you so much, and this is everything.